Hi class! The purpose of this video is to give you the material that would have been presented in class on September 25th. After many students left, a few came in later, and so I did teach this material to a smaller group of students, but I promised everyone that I would be posting all of the material online. So if you are not in class on September 25th, please watch this video and this series of videos so that you can get caught up. Here's an overview of what we are going to cover. Accounting for accounts receivable, inventory, plant, property, and equipment, and intangibles. So basically we're going through most of the assets on the balance sheet, and we are taking a manager's perspective of what managers should know about the accounting. So we're not worried about the debits and the credits, but we're worried about when transactions occur, how do they affect the income statement? More specifically, how do they affect revenues and or expenses? And how do these transactions impact the balance sheet? And when we say the balance sheet, because we're looking at asset accounts, we're thinking about assets and expenses on the income statement. The quiz that was supposed to be held last Tuesday will be held in the start of class this Tuesday. I'm going to start by going through the notes for class, and these notes are posted on Blackboard if you'd like to print this out and work along with me. Let's start with accounts receivable. When a company provides services on account, what happens to the financials? That's what we're focused on. Well, providing services means that the company is earning revenue, and on account means that cash was not received. Instead, the company sold and earned revenue, and from the customer it obtains a right to receive cash in the future. So what happens from an accounting perspective? Accounts receivable, which is a current asset, increases. And what else happens? Revenue on the income statement increases. When a company collects the account receivable, later on the customer is settling up and submitting payment, what happens? Well, of course, cash goes up. But now some students will be tempted to think that when we're receiving cash from a customer, that must mean that the company is earning revenue. But we have to be careful not to record that. Remember that what happens, the other side of that transaction is not revenue, because the revenue was recorded here. Accounts receivable, that current asset decreases. So when a company collects an account receivable, what happens to total current assets? Nothing. Cash went up and accounts receivable went down. All right, what else do we need to know about accounts receivables as managers? Some customers will never pay. We don't know which ones, so we sell on credit and we hope for the best. We do our monitoring of collections, but inevitably some customers will never pay. This amount of uncollectible sales is recorded as an expense called bad debts expense. You may have heard this term as uncollectible accounts expense. Same thing. Now, what do we need to know about this entry to record this uncollectible sales or bad debts expense? When bad debts expense is recorded, how does this impact the balance sheet and the income statement? Well, it's an expense, so obviously an expenses decrease net income, but what else happens? What happens to the balance sheet? Accounts receivable decreases, but not using the accounts receivable. We're going to decrease accounts receivable using a special tracking account called allowance for doubtful accounts. Allowance for doubtful accounts always reduces the value of accounts receivable, and the two accounts are always reported together. So the balance sheet reports the following information. It will report accounts receivable, the total amount that the company is should receive based on all of the credit sales that have not yet been collected. And the company will always report next to that the reduction to accounts receivable for that estimate of what they won't collect, the allowance for doubtful accounts. And we call the estimated portion of the cash that the company expects it will collect, we call that the net realizable value of accounts receivable. To realize something in accounting means to turn it into cash. So what is the total amount of receivables we actually estimate will be turned into cash? Well, we have to subtract out this allowance for doubtful accounts. Most companies that, if we look at publicly traded companies' balance sheets, typically we're going to see the term accounts receivable, comma, net. And what this net means is net of the allowance for doubtful accounts. Let's go to an example here before we continue on with our slides. Assume JCPenney had credit sales of $10.50, these numbers are in millions, during the year ended 2016, and a balance in accounts receivable of $270. Let's say that managers estimate that 1.5% of credit sales will be uncollectible. Where did this number come from? Well, we assume that the managers that are making this estimate are looking at historic experience for what has happened in the past. They're thinking about how the economy is doing. Maybe they have some information about what their competitors are doing, and they came up with this 1.5% of credit sales will never be collected. So what is the amount of bad debt expense? It's going to be, obviously, the credit sales. If we know the credit sales, if we're inside the company, we know the amount of credit sales. If we are outside of the company, we don't, so we only know total sales. So we just use the information that we have. So our amount of bad debts expense is $10.50 times 0.015. In the next slide, I have the answer here, 15.75. This will be reported as expense on the income statement. What is the amount of the allowance for doubtful accounts? Let's go here where I've worked out the information. The balance in allowance for doubtful accounts is this amount that is expected to not be collected. This will be reported on the balance sheet as a reduction to accounts receivable. So obviously this portion reduces our assets. And then what is the net realizable value of accounts receivable? Well, we're just taking the accounts receivable balance, AR of 270 minus the allowance of 15.75, and what we get is this 254.25. This is the net realizable value, or the total assets related to the accounts receivable. All right, let's look at some true-false questions. When a manager records bad debts expense, cash decreases. Take a second to think about what your answer would be, true or false. False, cash is not affected. The expense reduces net income and assets are decreased by that entry to increase allowance for doubtful accounts. Remember, this allowance, when we increase this account, it causes our total assets to decrease. True or false, when a manager records bad debts expense, current assets decrease. Take a moment to think about whether you would answer this as true or false. This is true. The entry increases allowance for doubtful accounts, which decreases the net realizable value of accounts receivable, which is a current asset. When a manager records bad debts expense, operating income decreases. Take a moment to think about your answer, true or false. The answer to this is true. Bad debts expense is indeed an operating expense. Let's return to our notes. Let's look at some information that managers should know about managing accounts receivable. Some of these are very basic and common sense. One is determine to whom to extend credit. Perhaps we want to run a credit check on some customers before we sell to them on credit, and maybe we have a threshold with which we are going to not sell if the customers don't reach that threshold. We're going to, of course, establish a payment period. Remember, accounts receivable typically do not charge the customers interest. So we do not want these receivables to be outstanding for a very long time, or essentially we're lending to our customers, giving them an interest-free loan. We don't want this to be too long. Of course, we want to monitor collections. Call those customers when their accounts are due and ensure that they are trying to make payment. And now for the more important ones, we are going to evaluate, this is especially true from an analyst perspective, evaluate the liquidity. Remember, liquidity means nearness to cash. How quickly can we turn those accounts receivable into cash? Sometimes we call this not only evaluating the liquidity, but evaluating the quality of accounts receivable. How do we do that is what you're thinking, and we are going to see that after we finish number 5. We're going to come down to evaluating the liquidity, and we're also going to start filling in our ratios here down below. In another video, we're going to walk through all of the ratio calculations for Walmart. All right, and number 5, what's another thing a manager should be thinking about? A manager might want to consider selling receivables. Typically to a finance company, sell them for cash, of course, for a fee, and in exchange the financing company will bear all the risk, but of course we're going to have to pay a fee for that. And we call selling these receivables, we call factoring. We don't want to hold on to that risk that our customers won't pay. Okay, evaluating the liquidity of receivables. If credit policies are too liberal, well, that's pretty clear what happens if credit policies are too liberal. We're granting too much credit and too many customers will not pay us back. How does that affect our financial statements? Bad debts expense will be very high. So as a manager, we don't want that to happen. If credit policies are too strict, what could the problem be? If we are requiring our customers to have credit scores that are unusually high before we will consider selling to them on credit, well, some of those customers are going to walk away, and they're either going to not buy anything, or they might buy from a competitor who has more reasonable credit policies. So if credit policies are too strict, sales revenue may be lost. Next, we're going to go down to our ratios for evaluating the liquidity or quality of accounts receivable. We have 2 here, accounts receivable turnover and the average collection period. I wanted to put all my ratios down together here, so we're going to just kind of go back and forth as we need to. So 2 measures of looking at accounts receivable quality, accounts receivable turnover. Well, what drives receivables? Accounts receivable are caused by one thing. They're caused by credit sales. Now, when we're an analyst from outside the company looking into a company, we don't know what credit sales are. We only know that if we are working internally in the company. So we're going to typically, ideally we're looking at the relationship between credit sales and accounts receivable. But as an analyst, we only have total sales. And let's compare the total sales to the receivables. But we're going to get a little bit more specific than just taking the ending balance in accounts receivable. We're going to find the average balance, and we are going to look at this balance in receivables net of the allowance for doubtful accounts. So we're looking at the average net accounts receivable. Now you might be wondering why we have this average here. Well, sales is an income statement item which covers a period of time. So when we're looking at during our ratios, we're going to use 1 year for the company. So this most recent year of sales relates to, well, the denominator is a balance sheet item. Remember, balance sheet items are at one point in time. So we can take the net accounts receivable or the net realizable value of receivables on the last day of the company's fiscal year, typically December 31st. But it could have changed throughout the year, so just getting a better measure that's lines up better to a full year of sales. And a balance sheet reports both beginning and ending balances in all your asset accounts. So it's pretty easy to pull up one balance sheet and quickly determine the average accounts receivable balance. So how do your sales compare to your average receivables? Higher is always going to be better. After we cover all of our ratios with the definitions, we're going to, again, work through an example with Walmart. Days in receivables simply takes our accounts receivable turnover and puts it into a number that might be a little bit more intuitive. We take the number of the days in these sales, so 365 since we're looking at full year, and divide that by that number we just calculated here, this accounts receivable turnover, to give us some estimate of how long were our accounts receivable, were we waiting for collection of them. So whereas the turnover, how many times are we collecting them, higher is better. How many days are those receivables sitting on our balance sheet, not as cash? Obviously lower is better. All right, in the next video, I'm going to walk through inventory.